The banking system operates like a finely tuned machine, designed to extract capital from those who don't understand the underlying mathematics of interest. Most people assume that when they take out a mortgage, their monthly payment acts as a steady, even step toward owning their home. This diagram maps a standard home loan, a $300,000 principal, a 5% interest rate, over a 30-year term. Run the math, and you get a fixed monthly payment of $1,610.46. That feels like a substantial monthly contribution, but how much actually buys the property? The breakdown reveals the reality. Out of $1,600, this massive red block, $1,250, goes entirely to interest. Only this tiny sliver touches the principal. This mechanism is known as the reducing balance method, or amortization. It is structured to ensure the bank collects its profit up front, leaving the borrower with minimal equity in the early years of the loan. If you want to evaluate the true cost of borrowing, always ask your lender to convert any advertised flat-rate offer into its reducing balance equivalent. The standard lending system is heavily weighted. It maximizes the lender's return long before the borrower makes any meaningful progress toward owning the asset. People who understand this math approach large expenses differently. This flowchart tracks the standard instinct. When a large sum of cash is required, the immediate reaction is to drain savings or sell off an investment, killing their compound growth in the process. The alternative is to retain ownership of the asset and borrow against it. This graph illustrates how a secured loan works. The upper line tracks a $100,000 asset compounding continuously, while the lower line represents the capital borrowed against it. Because the bank holds your cash or asset as collateral, their risk is essentially zero. That low risk dictates a deeply discounted interest rate for the borrower. You pay a minor interest spread for access to liquidity, while the much larger underlying asset remains untouched, continuing to generate returns. This structure provides three distinct advantages: avoiding a taxable event, preventing interruptions to compounding interest, and securing capital at a fraction of standard borrowing costs. By organizing the transaction this way, you remove yourself as a target for high-interest extraction and start leveraging the bank's own architecture to your advantage. This mechanic works across borders. A CD-secured loan in the United States functions exactly like a loan against a fixed deposit in India. For a used Land Rover, the buyer paid $68,000 instead of the $178,000 new price. They used a $60,000 fixed deposit as collateral. Borrowing at 8% bypassed 16% standard rates, and a credit card payment harvested $2,400 in points. The card payment and a $14,000 trade-in covered a third of the price, leaving a small balance. Financing this at a preferred rate brings the total monthly cash outflow to just $715 to $830. The buyer now drives a vehicle originally retailing for $178,000, but their monthly commitment is lower than the payment on a standard entry-level sedan. Most importantly, that $60,000 deposit never left the bank. It continued to compound uninterrupted throughout the life of the loan. The objective is straightforward: protect your capital, borrow against your assets, and use the bank's money to finance your life while your wealth remains untouched. Buying a high-end asset with cash creates a permanent hole in your compounding schedule. Once that money leaves your account, it stops earning for you forever. To avoid this, investors borrow against safe assets like certificates of deposit or fixed deposits. The account stays intact, the interest continues to accrue, and the bank provides liquidity based on that collateral. But this isn't just for savings accounts. The same principle of collateralized leverage scales across the global financial system, allowing for much larger plays. This hierarchy shows the progression of collateral. You use a house to secure a mortgage and a CD to secure a bank loan. At the highest level, you can use an entire stock portfolio to secure a massive line of credit. This allows an individual to tap into the liquidity of the equities market without actually selling their positions. Understanding this mechanism changes the role of debt. It reframes collateral as a structural tool for expansion rather than just a way to buy a home. A securities-based line of credit, or SBLOC, uses your stocks as the guarantee for a loan. It's the tool investment bankers use to fund real estate purchases or business deals without touching their cash reserves. Depending on the volatility of the assets you hold, institutions typically extend credit worth anywhere from half to nearly all of your portfolio's total market value. To see the advantage, look at a $100,000 stock position, where $70,000 of that is capital gains. Selling shares for cash triggers a 20% capital gains tax, sending $14,000 to the tax authority. An alternative $70,000 SBLOC at 6.5% interest costs $9,100 over 2 years. Crucially, that original $100,000 position remains intact and compounding. In this scenario, borrowing is mathematically cheaper than selling. This specific arbitrage is the mechanical core of the famous buy, borrow, die strategy used by the ultra-wealthy. The cost of this strategy isn't fixed globally. It is dictated by the interest rate environment of the specific country where you borrow. In the United States, the Federal Reserve sets the foundational cost for all domestic borrowing. In India, that baseline is established by the Reserve Bank of India. And for the Eurozone, the European Central Bank holds the lever. Currently, these institutions dictate wildly different prices for capital. The US Fed is at 5.25%, similar to India's RBI, while the ECB sits much lower at 2.25%. These base rates represent the floor. Banks then add an interest spread to determine the final loan cost. Global macroeconomics determine the exact math of the playbook. International borders dictate the specific price a billionaire pays to keep their compounding alive. The scale of this advantage increases when these asset-backed loans are executed through a registered business entity rather than an individual account. Buying a high-end vehicle through a business creates a dual advantage within the corporate tax code. The business deducts the loan interest as an expense and separately claims depreciation on the vehicle, up to 40% per year for electric models. A personal buyer has to pay the full interest and absorb the loss in vehicle value with no offsetting tax relief. Across every metric, cash, tax, and compounding, selling an appreciating asset is the single most expensive way to raise capital. What happens when this same cycle of leverage is applied to commercial real estate, or when an entire company is structured to exploit this math? The wealthiest players treat collateral as the primary engine for expansion. Every decision is built on the rule that while cash flow pays the bills, the strategic use of equity builds the empire.